My name is Yong Chen, metric number 293567. So for question 1, currency appreciation is a situation happens when the value of one currency increases relative to another currency. For example, suppose 1 Australian dollar equals to 3.2 ringgit last week. For this week, the rate changed to 1 Australian dollar equal to 3 ringgit. This means that the ringgit has appreciated, which is strengthened against the Australian dollar. Currency weakening is a situation when the value of one currency decreases relative to another currency. For example, suppose 1 Australian dollar is 3.2 last week. For this week, the rate changed to 3.5 ringgit. This means that the ringgit has depreciated or weakened against the Australian dollar. The fundamental distinction between nominal and real exchange rate is nominal exchange rate is the rate at which one currency is exchanged for another without adjusting for inflation, while the real exchange rate is the nominal exchange rate which adjusted for inflation differences. When the nominal exchange rates tell you how much foreign currency you can get with your domestic currency, while the real exchange rate can tell you the actual purchasing power and competitiveness of the currency. For the ringgit and US dollar example, when nominal exchange rate is at 1 US dollar equal to 4.7 ringgit, Malaysia has a higher inflation 6% compared to US 2%. The real exchange rate formula is nominal exchange rate times domestic price level divided by foreign price level. In this situation, we can get 4.89, which is show that the real exchange rate increase, and this show that the real depreciation of the ringgit. This situation makes that the Malaysian good become cheaper relatively to US goods on the international markets, even though the nominal exchange rate didn't change. A spot market is exchange of currency at the current market rate for immediate delivery, while the forward market is agreement to exchange currency at a fixed rate in the future. The settlement time for spot market is usually immediate, while settlement time for forward market is future date as agreed in the contract. The cases typically use spot market is quick settlements, travels, urgent trade needs, while the case typical use forward market is hedging future payments, budgeting certainty. For example, a Malaysian manufacturing firm imports 500,000 US dollar worth of machinery from US with payments due in 3 months. The company fears that ringgit might weaken against US dollar in the next 3 months, which will increase the cost. The company enters to a forward market contract with today locked in exchange rate of 1 US dollar equal to 4.7 ringgit. In 3 months, regardless what the actual spot rate is, the company will exchange ringgit for US dollar at this fixed rate only. To get the real exchange rate between Ringgit Malaysia and Japanese yen, we need the real exchange rate formula, which is nominal exchange rate times domestic customer price index divided by foreign customer price index. For the initial period, we can get 3.99 Ringgit Malaysia per 100 yen. For the final period, we can get a 3.88 per 100 yen. The real exchange rate decreased from 3.99 to 3.88, which indicating a real depreciation of ringgit to Japanese yen. This means that Malaysia goods have become relatively cheaper compared to Japanese goods. This increased the Malaysia trade competitiveness as export from Malaysia become cheaper and import from Japan become more expensive. For question 6, we need to calculate the final Malaysia ringgit return in both cases and suggest a better option. For case 1, we can invest in Malaysia at 2% of interest rate. The final Malaysia ringgit amount will get 153,000 ringgit Malaysia. For option 2, we can invest in UK at 3.2% interest rate. For the first step, we convert ringgit to pound at current rate, which we divide 150,000 with 5.5, we'll get 27,272 pound and also 73 cents. Then we times 1.032 interest rate, we'll get 28,145 and 45 cents. Then we convert pound back to ringgit at expected future rate, which we times 5.3, we'll get 149,170 ringgit 89 cents. This suggests that investing in Malaysia which yield a better return of 153,000 compared to 149,170 and 89 at UK. which show that investing in Malaysia is a better option. For question 7, we need to explain the long and short forward position. A long forward position is a situation when we buy a foreign currency at a fixed rate in the future when we expect the foreign currency will appreciate. We will get profit as the market rate later is higher. For example, a Malaysian company import UK goods in 3 months with £100,000 to hedge against the possibility that the pound may be expensive in the future. The company enters a long forward contract to buy pound at 5 ringgit 50 cents in 3 months. If the actual spot rate in 3 months become 5.7, the company will get benefits. For short forward position is a situation when we sell a foreign currency at a fixed rate in the future, when we expect the foreign currency to depreciate. We will get profit as the market rate later is lower. For example, a Malaysian exporter expects to receive £100,000 from UK for 3 months. To protect them against the possibility falling in value of pounds, the exporter enters a short forward contract to sell pound at 5.5 ringgit in 3 months. If the actual spot rate is 5.3 ringgit, the exporter will get benefit as they still get the pound at 5.5 ringgit rate. For question 8, we need to calculate the annualized forward premium or discount. The formula is forward rate minus spot rate over spot rate times 12 over number of months times 100. When we apply all the given numbers, we will get 2.22%, which is a positive number, which means the forward rate is higher than the spot rate. Therefore, the Australian dollar is trading at a premium and the ringgit is trading at a forward discount. For question 11, we need to calculate and compare the ringgit, proceed under both scenario and determine if locking in a forward contract was beneficial or not. First, we calculate the ringgit proceed under forward contract. We take 100,000 times 5.08 rate. We will get 508,000 ringgit. When we calculate the ringgit proceed under spot rate, we take 100,000 times 5.2 rate. We will get 520,000. When we base on the expected spot rate, the exporter will earn 12,000 more by proceed without a forward contract. Therefore, locking in a forward contract in this case was not beneficial. For question 13, we need to explain the absolute purchasing power parity and relative purchasing power parity. Absolute purchasing power parity (APPP) is a theory states the exchange rate between two currencies should be equal to the ratio of their respective price level for a fixed basket of goods and services. The formula of APPP is price of domestic divided by price of the foreign for the same basket of goods and services. For example, a basket of goods costs 200 ringgit in Malaysia and the same goods cost 50 euro in Europe. According to APPP, the exchange rate should be 200 ringgit divided by 50 euros. It will become 4 ringgit per euro. A relative purchasing power parity (RPPP) is a more flexible version of APPP. It states that changes in exchange rate over time are driven by differences in inflation rates between two countries. The formula of RPPP is future exchange rate divided by current exchange rate equals to 1 plus domestic inflation rate divided by 1 plus foreign inflation rate. For example, if Malaysia have 3% of inflation and Europe have 1% for inflation, RPPP predicts that the ringgit should be depreciated by about 2% against the euro. For question 16, we need to calculate the APPP when a situation a laptop is sold for 4,500 in Malaysia and $1,000 in the US. The market exchange rate is 4.6 ringgit per US dollar, and the APP formula is price in Malaysia, we divide by price in US. When we take 4,500 divided by 1,000, when we get 4.5 ringgit Malaysia per US dollar. Since the market exchange rate 4.6 ringgit per US dollar is higher than the APP rate, which is 4 ringgit 50 cents per US dollar, APP is not valid based on this data. For question 17, we need to calculate the non-arbitrage exchange rate based on APPP and explain whether arbitrage opportunity exists. We calculate by using the APPP formula, which we take price in US divided by price in UK, which we take $60 divided by 40 euro. We will get $1.5 per euro. The actual exchange rate is $1.4 per euro, is lower than the implied APPP rate. The pound is undervalued relative to the dollar in this case. The arbitrage opportunity do exist by buying the book in UK for €40, which costs $56, then sell it in the US for $60. We are making a profit of $4. For question 20, we need to calculate the APPP rate and explain if the arbitrage exists and what should the exchange rate to be to eliminate the opportunity. When we calculate the APPP rate, we take the price in US divide by price in Switzerland. When we take $90 divide by 100 franc, we will get $0.9 per franc. The actual exchange rate 0.85 per franc is lower than the APP rate. The franc is undervalued relative to the dollar. The arbitrage opportunity do exist by buying the jacket in Switzerland, which costs $85, and sell it in US for $90. So make a profit of $5. To eliminate the arbitrage, the exchange rate should be adjusted to 1 franc equal to $0.9. For question 22, we need to explain how the ringgit per yen exchange rate is determined, which include demand and supply concept, which is we show it in this graph. The equilibrium point is at point E, where the yen demand curve D intersect with Japanese yen supply curve S, and the exchange rate is S1 and the quantity of yen is Q0. If the exchange rate is higher at S2, it will happen excess of yen supply. As yen supply is more than yen demand at the point, we will access Q2 to Q1 quantity. If the exchange rate is lower at S3, it will happen excess of yen demand. As the demand is more than supply, we will access Q2 to Q1 quantity. For question 24, we need to calculate the expected future spot rate after 1 year by using the uncovered interest parity. We use the formula current spot exchange rate times 1 plus domestic annual interest rate divide by 1 plus foreign annual interest rate. We take 5.3 the current exchange rate times 1 plus 0.025 the domestic Malaysia annual interest rate divide by 1 plus 0.045 the UK annual interest rate. And according to UIP, the expected future spot rate after 1 year is 5.2 ringgit per pound. This implies the ringgit is expected to appreciate against the pound due to the lower annual interest rate relative to the UK. For question 27, we need to derive the condition for real interest parity by integrating the Fisher equation, the relative purchasing power parity, and uncovered interest parity UIP. First, we start with Fisher equation. We express the relationship between nominal exchange rate, real interest rate, and inflation. The formula is nominal interest rate equals to real interest rate plus expected inflation rates. Second, we continue with relative purchasing power parity, RPPP, which states the expected change in the exchange rate is determined by the inflation differential. The formula is the expected future exchange rate minus current spot exchange rate divided by current spot exchange rate equals to expected inflation differential. This formula can indicate when domestic inflation is higher than foreign inflation, the domestic currency is expected to depreciate. Third, we continue with uncovered interest parity UIP, which links the interest rate differential to expected change in the exchange rate. The formula is expected future exchange rate minus current spot exchange rate divided by current spot exchange rate and equals to the differential between nominal interest rate. When a higher domestic interest rate suggests the domestic currency will depreciate to prevent the arbitrage. Step 4, we're combining the RPPP and UIP. We take the domestic inflation rates minus foreign inflation rate equals to domestic nominal interest rate minus foreign nominal interest rate. And step 5, when we plug in the Fisher equation, we get the domestic nominal interest rate minus domestic inflation rate equals to foreign nominal interest rate minus foreign interest rate, which equal to real interest rate in domestic and real interest rate of foreign. This is the real interest parity condition when the real interest rate must be equal across countries that share all of the same characteristics.